Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Caroline Hyde and Paul Sweeney, we are live here in our Bloomberg radio studio here in New York City, Bloomberg HQ, a special edition of Bloomberg Markets here on this Black Friday. Renowned economist Nouriel Roubini is warning that Donald Trump's agenda of tax cuts and tariffs is shaping up as a double-edged sword for the United States. The CEO of Roubini Macro Associates told us more about the potential impacts of Trump's plans on inflation and growth.
The economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion, too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis. Some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for a lot of reasons about cryptocurrencies and Bitcoin, because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
That was Nouriel Roubini speaking with Bloomberg Intelligence analyst Eric Balchunas. Meanwhile, we want to delve in a little bit more to just these markets. The S&P 500, of course, on a tear, one of the best years in history. That's as investors have just been methodically shrugging off geopolitical risk after geopolitical risk after central bank temper concern and inflation perhaps running a little bit warmer than had been anticipated. We've got to sort of try and analyze, therefore, what in market it's been for the moneymakers out there, the banks in particular. It's not been pleasant if you've been trying to make these markets in Forex and rates. They've not been having a great year for traders there. They're hit by tighter margins, by challenging macroeconomic backdrops. We want to get to it with Jess Menton, who's been going through what is a great story of how difficult it has been to trade the macro of late, because there's been these shock moves that go against everyone.
It really is. And especially because Paul and I have spoken so much over the last couple of years about, especially going into not even just this past year, but in 2023, after we saw the low in the S&P 500 in October of 2022, there's still so much gloom and doom. And a lot of it has been, especially when you're coming out of COVID and what the disruptions from the pandemic did, because a lot of people were trading off of playbooks that would have worked maybe prior to the pandemic. But when you have a once in a century pandemic like that, and it upends business business activity, it made a lot of the trades tougher to call because there were certain strategies where you would use, for instance, if this happened, you'd buy this, or only, there would be 100% track records for certain thresholds where, you wouldn't see the S&P 500 hit another low. But there were a lot of things they had to throw that playbook out. And I'm sure, Paul, in your career with a lot of things you saw, especially if you thought about the housing crisis, or I know you were on the floor a couple weeks before the 87 crash.
Oh, yeah.
Things were very different when you think about pre-COVID versus now. So especially on the macro side, if you're looking at the Citi Economic Surprise Index, particularly for the U.S., that's continuing to outpace those expectations. And even if you're looking at fourth quarter GDP growth for the Atlanta Fed GDP Now model, that's above 2.5%. So still you're continuing to see strong consumer, but also on the corporate side of things for particularly the stock market, that's continued to power things higher. And Gina Martin Adams always talks about that too. So those have been some key indicators, Caroline, why a lot of these things just haven't panned out for some of these banks.
And some of it used to be, I'm not going to say used to, but some of the biggest profit generators were from the macro traders.
They were. At
the sell side firms. And then the hedge funds in particular, you're a macro trader. That just meant you were smarter than everybody else. I didn't think about equities or bonds. I think about the macro picture, everything. And those are the guys and the gals that made huge amounts of money. But I've heard that, again, the performance has not been there.
No, they haven't been.
I wonder if the funds are pulling out. The fund flows out of those strategies.
Oh, so that's a key thing too, because even the S&P 500 right now, it's on pace for over 20% gain this year. That's the first time you'd see back-to-back gains of that type of magnitude since the late 1990s. And we saw that happen twice during the dot-com bubble, but continuing to see even going into next year. It seems like every year when the calendar turns, there wants to be this kind of doom and gloom. I know a lot of people are pointing at valuations, say like the S&P 500 right now trading around 22 times forward earnings on a blended basis if you're looking in the terminal. If you look at the average over the last decade, it's around 18. But even if you strip out the Magnificent Seven, it's still around 20. But a lot of traders I speak with, they'll point to how valuations, especially if you look over the last 10 years, or even if you want to look at sentiment, that stuff can stay kind of frothy and grow on for weeks, months, even potentially years there. So they tend to not like to use that for trading strategies right now.
What's interesting, I think it's Coalition Greenwich, which has been putting together a lot of this data around the moon music for rates traders and for Forex. A little bit more optimism if you're trading foreign exchange, but rates is painful in large part because of electronification here as well. Things look very different 20 years ago because there were fewer market makers and most people were still picking up a phone.
That's a good point. And it's just a different dynamic of how interconnected the global economy is, as well as technology when you're trying to make some of these trades too. And so when you're looking at kind of the Forex market versus the rates markets too, especially because the conundrum of when you're seeing yields rise, whether that's, was that on a strengthening economy or is that trying to tell you something about Federal Reserve policy? It's make it a lot more of a conundrum coming out of COVID too, Caroline.
So what's the smart trade for 2025? Is there such a thing? Or am I just buying NVIDIA?
Right, I know, because especially with that, NVIDIA, the third quarter didn't do as well as it had in prior quarters, but still the best stock in the S&P 500, not over even just the last year, but the last 2 years. But something that people are watching, if you look at the ETF that tracks semiconductor companies and chip makers, SMH, that's important because there's a level around 240. It's trading around 242 right now, but the 240 is kind of more of a broad support measure that they're looking at. So you kind of want to look at that as a gauge, not even just for semiconductor companies, but also kind of more broadly for the stock market to see what that could mean, because not surprisingly, the big weighting that chip makers have.
We're going into software. 500,
that's
what I hear. Exactly. Software is going to be the new trend.
Right. And so that's a big thing too, because it's beyond even just some of the big AI type players there. But when I'm speaking with a lot of portfolio managers, that actually is a space like Marianne Bartels. She's on Bloomberg a lot too, but software companies is one of the ones that she continues to plow money into.
All right, Jess, ESPN.com, Texas 5.5 point favorite. Put a little action down there.
I was not able to get a ticket, unfortunately. We were talking about how expensive those. I think the average purchase price was over $1,000
Big ticket.
this
experiential.
Right.
Experiential.
That's what the kids are doing. Texas at Texas A&M. College Station, Texas.
That's right. It's going to be great. I'll watch it here.
Exactly. Jess Menton, thank you so much. We appreciate it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Christmas trees.
Have you got yours?
No, of course not. I buy my Christmas tree on or about my birthday, which is early December.
Real one?
And yes. Okay. But I've gone both ways over the years because my kids were younger. They had some allergies. So we would go for several years. We went the fake tree. I'm kind of indifferent.
Yeah, we got a bit of both.
You do?
We get one real one for the smell.
Yes.
And one fake one for the downstairs.
Right.
Vibes.
Okay, so that's how you do it. All right, it all works out. People have their play there. Chris Butler joins us, National Tree Company CEO, joining us here, I believe, from Cranford, New Jersey, which is a cool little town there. So, Chris, talk to us about kind of Christmas decorations. What are people doing these days? What's different today versus, 10 years, 15 years ago? It seems like people are going nuts for Christmas decorations.
They are going nuts. Yeah, and I like what both of you guys said. You switch between the artificial and the real. We're big fans of real, as well as artificial. Obviously, 80% of U.S. consumers buy artificial trees, and so the real is definitely the minority. But again, obviously, we're big fans of trees in general. But it's the pre-lit now. So trees come pre-lit. Obviously, there's no mess. They're a lot cheaper. The materials are a lot better. There's a lot of functionality with the lights that you can get today. And so that's really what we're seeing. And there's a lot of extra wreaths and garlands and things being bought as well. And I think with the Instagram generation, the show me generation, people are really now decorating to kind of show their friends and show their followers just how beautiful their homes can be. And so, as you said, Carolyn, they have a lot of trees in a lot of different rooms. And so, maybe the kids have a tree now. The kitchen has a small tree, putting the mantelpiece with garlands and small trees. So, we're seeing a lot of incremental decorating with a lot of different items. And in terms of getting back to that swell thing, so you're right, the main reason people buy a real tree is for that real Christmas smell. We bought a company called Sensicles a few years ago, and they are a scented ornament which smells just like Christmas. So if you hang your scented ornament on an artificial tree, you get that real tree smell as well.
And no allergies. One might assume. I'm looking at, I got onto your website. First thing, holiday magic begins. Enter a week, win a gift card. Blackout Friday, blowout deals up to 80% off. How much are you having to think about discounting? How much amid perhaps fear of some that where you're getting your supplies from, the cost might have to go up in the future?
Yeah, no, it's a great question. So look, Black Friday through Cyber Monday this year, obviously it was 1 week later. So the holiday season is a week later. So I think every retailer, us ourselves included, are really discounting to make sure that we can kind of capture those sales that we might have missed otherwise, given the week's delay. In terms of the tariffs, look, we've been on a diversification trend over the last few years now anyway, trying to diversify ourselves out of just one source of manufacturing, which would be China. I think if the tariffs go through, who knows what the tariffs will be or when they will go into effect. But, from our standpoint, obviously it's impactful. And so we're trying to diversify our manufacturing base between now and kind of 2026. The promotional things we're doing right now really aren't in answer to that. It's really more just to kind of capture those sales for this season. But if you are a consumer, and you're looking for a tree and you're thinking of buying a tree or other holiday decor, this year is a great time to buy it, because if those tariffs go into effect, prices will definitely go up in the next year or so.
Can you give us a breakdown of sort of how much of your supply chain is dependent on China?
Yeah, it's very large today. So I can't give you the exact numbers, but it's very large. But we are diversifying out. We've been on this diversification journey for a few years now. Yeah. And so, probably by the end of 2026, we could be completely out of China, which, is a significant change.
So anything particularly the hot seller this year, Chris?
Yeah, so it's funny. So my wife loves the sparkly trees, the snowy trees, and many consumers love those things. But, what we see year after year after year is that green triangle, the kind of the staid, good green triangle, solid materials, great lights, multi-function lights. So, it's not a trend-driven industry. I will say this year, disco is back. So kind of a bit of a retro feel for disco. Who doesn't love a bit of disco with their Christmas tree? So disco is back. So we've definitely seen some sales on some of our kind of disco themed items. And but again, it is, people still do prefer that traditional green tree with either the white lights, clear lights, the multicolor, or again, we have the dual color functionality. So that's what we see every year.
Are you white lights, Caroline? Or are you a different color?
I think one of ours has multicolored. But I think in general, I'm a boring person. I like a white light with only red and gold vibes going on. And then our thing is we collect Christmas decorations from any city that we go. So then, and then you have to remind yourself where the hell you got some of these random items. But I'm really interested in not just about the idea of what color lights or whether you're doing sparkly or disco. But you must be talking, Chris, to people in your industry that are doing the real tree situation too. How much you're going to have help this year by the fact that we're here in the Northeast, we've had terrible lack of water. Yeah. We've had droughts and the local Christmas tree farms next to me have been struggling.
Yeah, it's a great question. 80% of consumers already buy artificial trees. Versus 20% of consumers buying the real trees. So it's a small market already. And unfortunately with some climate change or with some just weather in general is definitely hurting. Look, Oregon a few years ago got hit. There's some fungus issues in the Carolinas. So it's a tough business to be in, doing those real trees. And look, we're here to pick up the pieces when they falter with some of their supply chain.
Chris, is there any regionality in your business? Do people in the South, spend more on their decorations per capita than the Midwest or anything like that? Or is it pretty standard across the board?
It's pretty standard. We do see the coastal towns going more for kind of Christmas by the sea type themes. But typically, our sales are driven by population centers. So, very good sales in the Northeast, obviously, California, Texas, Florida. It's really population driven. We don't necessarily see big regional differences in our sales anyway. We sell, most of our sales are online. So we sell through Amazon, Wayfair, Home Depot, Macy's, et cetera. And so we really see sales driven by, by where people live.
Hey, Chris, thanks so much for joining us. Really appreciate it. Chris Butler, National Tree Company CEO. Caroline, have you noticed differences in the way people decorate their houses here in the U.S. versus growing up in England?
That's a great question. More is always less here.
But we're more, right?
Yeah, you are more. You are more here in the United States. And I love that. There's like a tree for every room, a tree for every person in the family, every animal that you might have. So I'm all in on that. I feel in the UK, we were a bit more dependent on real trees, right? Just as a general. We're a smaller country and easier access to them. But
is there something that you guys do in England that we don't do here decoration-wise?
So Advent calendars.
Advent
isn't deemed like a religious taking part in the UK. Obviously, the Queen of England and King of England. Generally there is a little bit more focus on Church of England within the country. But actually, the countdown and a 24-day opening of a calendar, whether there's a sweet, a candy, an act of kindness in it, that was something that I grew up with. I found it much harder to get here. And crackers is my other one. Now suddenly we're getting them everywhere. I'm seeing my local store has crackers, has advent calendars. I'm thankful.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Black Friday, it's important for retailers. This is it, folks. Do you know why it's called Black Friday? Because you're running the red all year. Ding. And then Black Friday comes into a big advertising year. Big sales year, and you kind of go into the black. You become profitable. Black Friday. Dana Telsey knows that better than anybody. Dana Telsey, Telsey Advisory Group CEO and Chief Research Officer, the go-to voice on Wall Street for all things retail for, I'm going to say 25 years, and I'll leave it there. Dana, it's been a wild 4, 5, 6 years for folks trying to figure out how they spend their money, where they go. Do they spend it on goods, services, experiences? Give us a lay of the land of retail here on a Black Friday 2024.
First of all, you're exactly right, and thank you for having me. It is the Super Bowl of retail, always on Black Friday. Retailers prepare for months in order to get it right. So what do you do? What is happening right now with retail? I think the consumer is resilient. I think it's about product newness that's driving sell-through and conversion. Look what you have with companies like a Birkenstock, a Ralph Lauren, Deckers, and on. And then it's also about value, because that lower income consumer, they are being very watchful about their dollars, given what they're seeing out there, the continued pressure of elevated prices. Inflation might not be going up, but it couldn't come down fast enough for them. And that's why you saw Walmart talk about the fact that most of their share gains came from the higher income consumer. And given that 60 to 65% of their sales come from grocery, you look at Target, which has more coming from discretionary, nearly half, that was the headwinds. And then you look at what's happening with gift giving. Who would have thought that the off-pricers like TJX, they're getting in the throes of gift giving and they're gaining more traffic. But what every retailer is doing this holiday season, increasing the marketing. You have a very social consumer who basically is enticed, whether it's by their phone, whether it's by emails or in store. And yes, what we saw this morning so far, because I was at Macy's too already, as the mornings come on, you've seen traffic increase. And I think that social engagement with the physical store is helping. We also have a compressed holiday season. Don't discount that. Thanksgiving on the 28th. Last year it was on the 23rd. The pull forward of promotions led to more conversion earlier in the season, but consumers are still going to spend. A lot of them are procrastinators.
Am I going to get deals, Dana? What's the promotional environment like out there? Because that impacts the margins for your companies.
It does. Average promotion these days seems like around 30%. When I did my walkthroughs yesterday, I even found a store that's open because you know me, I have to be in a store every day. Aritzia in Soho was open. Just opened on Tuesday, brand new store, absolutely beautiful. But overall, it's around 30%. That's the discounts. Some of them may be higher, some may be a little bit lower. Luxury goods is having a tough time, but you never see discounts at luxury goods. What you need to see on 57th Street is those Louis Vuitton trunks. But overall,
gorgeous,
beautiful. I think it'll be a resilient holiday, a 3 to 3.5% increase. On the margin side, increased marketing is planned. The promotional levels are planned. I think there's more stability in the margins, more uncertainty what the top line looks like.
More uncertainty if you're starting to think the costs are going to go up because of tariffs.
Yes.
Are consumers even considering that? Because I'm pretty sure the retailers are.
The retailers are considering it big time, and the diversification from China is playing at every single retailer. Look what you had this week when even a Abercrombie & Fitch talked about less than 10% of their goods coming from China. Look what you had with Gap talking the same thing. On apparel, when those who have significant exposure, and a lot of it is footwear companies, they're working to diversify fast. Because if anything, look at the NRF study where nearly 80% of consumer spend dollars would be impacted by tariffs, requiring nearly a double-digit price increase. Consumers don't want that.
They definitely don't. Do they want to be shopping via influencers, or do they want to be shopping via their own viewpoint and long-term love affair with certain companies and brands?
I think influencers create the viewpoints. I think influencers help the consumers overall see what's working for them. The brands also advocate for influencers too, because they want that awareness given to expand their demographics. Because influencers today, it could be for millennials, it could be for baby boomers. What you know is consumers are watching pictures. Pictures are on Instagram, they're on social media. And I think that's going to be one of the bigger themes as we move through 2025.
Dana, e-commerce versus bricks and mortar. I know the pandemic brought a lot of e-commerce market share forward. How's that dynamic these days?
Overall, you need both. You can't have one or the other. It's got to be both. And what you're seeing is the store fills a broader function. They do buy online, pick up in store. They do ship from store. And you know what they do? Back to that word again, social. They create social engagement. So I think overall, you're going to continuing to see bigger gains in the holiday season from online. Should be high single digits this year. But you need that bricks and mortar in order to drive awareness. And you're seeing more retailers invest in their stores. You have more stores being opened in terms of retailers and net openers, but of a smaller size box than in the past. Go physical is what I'm about.
Go physical. I mean, even on Thanksgiving, you might go and find a store that's open. I mean, I feel like Black Friday deals have been thrown at me for the past week, if not longer. I mean, we were reporting on, of course, 11/11 and what happened with the Chinese discounts that just were never ending in terms of length that we had for Singles Day. Is this just the new world order? Do we feel like there ever isn't a discount on?
I think one of the things that happened this year, it just started earlier.
Yeah.
The minute Amazon had their Prime Day, and then you had the Target Circle Week and Walmart in October, it was game on for the holiday season because everyone wanted to capture as much as they could of that consumer spending dollar, because it's back to school in the fall and it's holiday that are your two key shopping time periods.
anything the go-to gift or item this season?
I mean, you're going to look for Birkenstock closed-toed shoes.
See,
that's going
told
to be That's going to be a go-to that people want.
Birkenstock closed-toe shoe, as opposed to the Birkenstock sandal.
Yes, but you got to have both.
Okay.
So, and then you know what? Look at the Brooklyn bag at Coach. That's been super popular lately. On Running in their footwear, that's been working very well too. So we've got things, and you know what? Even some of the private companies with intimate apparel, like Skims, you got to watch what they're doing.
They have some cool marketing campaigns as well. Dana, it's always great to have you. Thank you for making us a
so
pit
much.
stop. She's going to pop to Bloomingdale's next door now, Dana Telsey.
I'm going there next.
CEO and Chief Revenue Officer at the Telsey Advisory Group. Always a joy to have her.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I haven't seen Gladiator II. I haven't seen Wicked, but I got to do that maybe over the weekend. But that's been some positive story here for the U.S. box office. Daniel Loria joins us, editorial director at the Boxoffice Company. Daniel, talk to us about kind of the state of North American box office here. Are people going to the movies?
Oh, it's a hot streak, Paul. We've seen great recovery so far this year. Remember, we entered the year expecting a down season year over year, 24 to 23. But really, since June, it's been a hot streak. We're expecting to finish the year close to even to 23 after beginning the year expecting a 10% slide. So it's been a really, really big recovery thanks to films like this.
I mean, Disney just knocking it out the park at the moment. They've had winning formula after winning formula. How big a deal is Moana 2 going to be?
I think it's going to be huge. We just posted the largest Thanksgiving day ever for a title. Moana 2 did that yesterday. Over $80 million in box office for the first 2 days in release for Moana 2. We're expecting maybe $200 million plus from that title this weekend. To give you an idea, guys, this might be the highest earning Thanksgiving weekend of all time.
And is that because they've got the formula right of there's something for everyone as well? When one of my producers, she was off to go and see, well, not to typecast, but she was going to go and see Wicked while her husband was going to go and see Gladiator II. There's something for everyone. And then there's the family formula with Moana 2. So we're all satiated.
Caroline, I think you nailed it right there. We have something there for every type of audience at the movies this weekend. The Gladiator II opening weekend audience was 61% male. For Wicked, 72% female. And obviously family audiences are coming out to support Moana 2 en masse this weekend. Those three movies occupy 75% of all showtimes in North America, according to our data at the Boxoffice Company. That's a massive response from theaters to the overwhelming demand from audiences to watch these movies in theaters.
So, Daniel, give us a sense of maybe how the Hollywood movie-making moguls out in L.A., how are they thinking about the theater release window versus the streaming and all that kind of stuff today versus pre-pandemic? Is it still what it used to be, or is it a different world?
It's different from 2019, but which industry isn't, right?
Yep.
The big lesson I think that the entire industry in Hollywood has learned is the overwhelming role that a theatrical release has in promoting your title downstream. So streaming is still very important, but that theatrical performance is crucial. Let's take Moana 2, for example. A year ago today, that was supposed to be a Disney Plus animated series just for streaming. Today, this is $1 billion plus global box office hit for Disney. Disney now with two huge animated movies, one earlier this year, Inside Out 2, this one, Moana 2, and then you have other titles like Deadpool and Wolverine from over the summer, and in December, Mufasa, that Lion King prequel. You have a lot of energy from Disney to go big on theatrical, and we see the box office numbers to back that up.
Hey, Dan, I listened to some of the conference calls from some of the big media companies, the Disneys, the Warner Brothers. They're kind of pointing us to 2025 as a really big theatrical release year, you know, due in large part to some of the writers and actor strikes that push some production out. Talk to us about next year.
Paul, I think you're absolutely right on that. If we look at the last 4 years in production, Hollywood hasn't had an uninterrupted year in their production capabilities since 2019. You had the pandemic in 20 and the strikes last year. 2024 is the first full year of production in Hollywood since 2019. So 25 is going to be a huge bounce back for the theatrical industry. We're right now forecasting between $9.5 and $10 billion in box office in 25. And in 26, we have a ceiling of $11 billion, that benchmark that this industry hit in the latter half of the 2010s.
What is spending like when you're actually going to the theater?
I'm sorry, what is the spending like?
Yeah, are people like embracing it wholeheartedly? How much of margin is accrued to those that are running the movies as well as making them?
I think you're seeing a lot more embrace from movie theaters right now in reinvesting back in their theaters to make sure that that experience is as perfect as possible for the audiences. Let's face it, the technology we have at home is great. So the theatrical experience has really invested a lot in making that experience either inside of the auditorium, in advancements in sight and sound, or in the lobbies with alcoholic beverages or expanded menus, in making that more of that experience. And I think audiences are responding to that. You listen to those conference calls that Paul was saying a second ago on the movie theater side, you're seeing huge margins on the spending side on food and beverage. That's been a big uptick since the pandemic. And formats like premium format, that means our friends over at IMAX or at Dolby or at or other of those companies with a higher ticket price, consumers are looking for that to have the best possible experience at the movies.
The thing is, for a Gladiator II or for a Wicked, these movies in particular cost a lot to make. And I'm interested as to the marketing spend that's gone with Wicked or the sheer technology effort that was needed with a Gladiator II. Are they making that money back and then some? How much are they managing to crack the code that the movie that they spend a lot on is the one that they bring in a lot of money on?
Carolyn, what you just said right now, I think is a big reason why the studios are highlighting and emphasizing a theatrical release. The more release windows you have in different formats, the more of a possibility you have to break even and make more money over the lifetime of a film. If you go to streaming too early, or if you only did streaming, you only have one revenue cycle there, one small window to get there. With a theatrical release, you could have 3 months of success at the box office, and from there have that amplify your marketing when it goes into streaming to have that second dip in the revenues. So having a long life cycle for films is crucial, and that's why I think a lot of movies and a lot of studios have gone back to this windowing of theatrical first and streaming second to make sure they can hit the numbers they need for their shareholders.
Daniel, talk to us about China. Before the pandemic, China was rivaling North America in terms of total box office. It was really a gold mine for Hollywood. Is that still the case?
You know, I don't think it has as much of a role as it did in the pre-pandemic era. Obviously, the pandemic raised a lot of question marks on who was going to be the box office king. But really, from the studios, what we've seen is less of an emphasis to make sure that they lock down that Chinese release. It's just such a gamble, Paul. You don't know what you're going to get from a release in that market. If you get it, it's great. A movie like the third installment of the Venom series is doing fantastically in China right now, but it's far from a guarantee. I think studios agree that having a strong domestic release and a reliable turnout from overseas audiences in markets in Europe, Latin America, and other markets in Asia, that's still the winning formula for most movies.
What about AI and whether it will be adopted more next year?
Huge talking point, right? I think that's still up in the air. There's a lot of things that we need to figure out and what that means for actors, what that means in labor relations. A big part of the strikes last year were around these questions. Like in many industries, AI has a lot of potential. I'm not sure it's a reality just yet.
Well, I have so much more to debate on all of that. We thank you so much for joining us. Daniel Loria, Senior Vice President of Content Strategy and Editorial Director at the Boxoffice Company, making us all want to go out and watch some movies.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.